Hello and welcome to Sisters for Financial Independence. My name is Catherine Agupjan, and here at Sisters for Fi, we help you manage your money better so that you can live a life of impact today and tomorrow. This video is part of a series on investing as a college student. And today we are going to talk about some of the factors you need to consider when you're investing for the first time as a college student. Investing is an important part of adulthood, and if you ask anyone, they will tell you it's best to invest early and often. And yes, you can invest as a college student, and you can actually invest at any age. If you're under 18, you will need a parent or a custodian to help you open an account. But if you are 18, you can open your own accounts. And we are going just to cover a few factors that I just want you to think about before you open your first investment account. Not understanding some of these factors may mean impact on the FAFSA or may mean more taxes down the line. The first thing you want to consider is, where is the money for your investing going to come from? Is it coming from parents, a part-time job, from money you've saved up? Is it coming from a loan disbursement? And you need to understand the opportunity cost of this money. If it's sitting in a bank account, it is most likely not earning you money, definitely not earning you enough to fight inflation, so you're losing purchasing power there. If it is a loan disbursement, you need to think clearly about the cost of that money. What's the rate of borrowing? What is the interest rates on that money? And is it worth investing that money into the stock market? Historically, the stock market in the past few years has averaged and returned 8 to 10%. So you could potentially make more money if you're borrowing at a lower rate. But if you are not, if you're some of your private loans, or if you're going into credit card debt and those are over 10 to 12%, it may not make sense to invest today. It might make more sense to reduce your debt or even eliminate it. Use the funds today to do so. The next thing you want to consider is the impact on the FAFSA. Now, student-owned assets count fairly heavily in the FAFSA, meaning if you have money in a brokerage account or a savings account, it will count more towards a FAFSA and it will reduce your eligibility for financial aid. There are calculators online you can use to do so, but certain accounts and certain account ownership will have a larger impact on the FAFSA. I'll show you a list of those in a few seconds so you know what that looks like and you know what type of accounts to avoid or reduce so it doesn't impact your eligibility for financial aid. And you need to think about that if you're going to invest today. Is it worth reducing your aid either from the college or even from the federal government to invest and get some gains today? The next thing you want to consider is the type of investment account or investment vehicle you are going to open to save taxes. Now, there are certain accounts out there that will provide you tax advantages either today or when you withdraw in the future. Now, for a lot of first-time investors, many automatically open a brokerage account, and unfortunately, a brokerage account is an account that does not have any tax advantages at all. So you need to think about that when you open your first account. An option might be opening an IRA. And for someone young and with a little bit of income, a Roth IRA might be a better option. With a Roth IRA, you invest post-tax money, so money that has been taxed already, and it grows and provides you earnings. And when you are ready to withdraw at the age of 59 and a half, you can withdraw your money tax-free. And there are some exceptions to this, so there's still ways for you to access that money should you need it in the future. I have a video up here to provide you a little bit more detail of IRAs and how you can use it. The big thing about the IRA though is that it requires earned income. So if you're working a part-time job, have a W-2 at the end of the year, or even a 1099, this could be an option for you, and you need to start thinking long-term when it comes to investing. One of the things that you want to think about when it comes to investing is who owns the account and what is its impact on the FAFSA. Now, this is a post from finaid.org. I will have all the links in the description, and basically it provides you a table of the effect of the savings vehicle on the financial aid treatment. So let's start with one of the most common ones, which is your Coverdell education savings account, and it'll provide you the financial aid treatment. So it counts as an asset of the account owner. And here's the thing, high impact if the student is the owner, but low if it's the parent. Now let's scroll through the 529. Again, asset of the account owner, it's low impact if it's owned by student or parents, high if it's a third party. Now let's move towards UTMA or UGMA. Now these are custodial accounts. If you are under 18, you would need to open an UTMA or UGMA to be able to invest. And this is it's asset of the beneficiary, so this most likely means you, and it will have a high impact on financial aid. Let's go towards your IRAs. Now, traditional IRAs and Roth IRAs are not reported in the FAFSA, so it's low impact. There might be other college calculations when it comes to specific college financial aid that this might be included in, but at least for the federal financial aid application, it's not counted, so it has low impact. Let's also look at the regular taxable investments, and this will be your standard brokerage account. Now again, going back to the asset owner, low impact if it's the parent, high if it's student owned. So you really need to weigh if it's worth the gains that you're looking at when it comes to investment is worth it for it to perhaps ding a little bit of your financial aid. Now, of course, this doesn't mean like investing a whole lot of money or being able to make a whole lot of money within your investments for this to really matter, but you never know when it comes to investments, so just think about that when you're investing. The next item that you are going to consider is the type of investment platform you're going to use. There are many out there, from robo-advisors to discount brokerage. And in most cases, many of these platforms basically do the same basic things, allow you to buy and sell stocks, mutual funds, ETFs. And don't get hung up on finding the perfect one, because there's most likely not. You just need to figure out what your needs are. And as a first-time investor, I want you to look for a few things when it comes to the investment platform you're going to use. One is support for more than just a brokerage account. This is important, especially if you end up getting a part-time job and want to open an IRA. You might want a platform that will support that. Support for buying and selling of stocks, mutual funds, and ETFs. That's probably common across the board. The ability to automate transfers from a savings account and invest it into your investment account. This is something that you will want to start getting used to, getting the recurring transfer, so you're automating your investments often. The next thing you might want to look for is a platform that doesn't have a minimum investment, so that you don't have to get bogged down by that you need a lot of money to invest. Maybe $10 a week, $20 a week as a start will be good. The other thing you want to look for when it comes to an investment platform is support for fractional share investing, which this is the concept that allows you to buy a fraction of a share of a stock. And this is good, again, if you don't have a lot of money and really want to start buying stock. this is a great way to get into that, so that you're not again getting caught up on like you needing a lot of money to start investing. And the last thing too is a platform that supports dividend reinvestment. Dividend reinvestment is a key feature of long-term earnings and growth. So you want to be able to reinvest your dividends automatically so that it grows for you over the long term. The last thing is to avoid platforms that charge you transaction fees, commissions, and all of these hidden fees. You want a platform that is transparent with what they're charging you, because all of those fees will eat up your earnings, and you don't want something like that eating up your money, because it means you won't have so much to invest and grow. And I think one thing too is that you can always change your investment platform at some point if you find that it's not working out for you. So start with one, and then as your investment knowledge increases, you have more money or you have more options as far as investment accounts that you can use, then switch to a larger investment brokerage firm that provides all of these options for you. I just want to briefly mention Robinhood here because it is a very popular platform. And one of the things that unfortunately Robinhood does not support yet, at least as of March 31st, is their retirement accounts. So these are accounts that provide you some tax advantages today or tomorrow, and this means the traditional IRA or the Roth IRA. So you won't be able to open yet, at least a Roth IRA within Robinhood. And if you've been trading within the platform for the past few years and you had a gain, and if you have short-term gains, you will have to pay short-term capital gains on those assets that you've sold. The next factor that you'll want to consider is really about the length of time of your investments. When you're investing, you want to start thinking long-term, over 1 year, 5 years, 10 years, because that's where really the compound interest and the growth of money works well. Short-term investing is great and provide you a lot of lessons, but it doesn't give you as much as you might want, because you'll be paying more in taxes when it comes to short-term capital gains. So what you're earning will be going to the government instead of really funding your future. So when it comes to investing, think long term, think about those tax advantages. What accounts will provide you those tax advantages, because you want your money to be in the market for over many years. Absolutely more advantageous for you to invest in a diversified set of portfolio that provides you access to a lot of companies, industries, so you have that range of risk and reward as a long-term investor. If you want to learn more about what that means, check out the 3-fund portfolio and how you can use that 3-fund portfolio to start building that nest egg that's diversified, low cost, and provides you a range of options when it comes to companies and stocks that you can invest in. Given all of those factors, I still believe that it's important for college students to invest. Now, you might not be able to invest a lot, but even a few dollars a week can get you started that investing journey, get you into the habit of consistently and automatically putting the money aside to invest for your future. There's also fairly little risk to invest today, especially if you're starting with a small amount. So the risk of loss is fairly small. And over time, as you become a more seasoned investor, then you can be taking more risk down the line. And investing early means you start getting the confidence in putting your money in the stock market. You're weathering the ups and downs, and you are able to emotionally deal with the roller coaster that is the stock market and be able to hold your ground with your investment plan and strategy. Just remember that if you are going to be investing for the first time, really think about what investment account you can be putting your money in, how much money you can be putting in, and if you feel like you're going to be withdrawing that money within the time that you're in college, what will its impact on the FAFSA? In a future video, we will cover how to invest. We'll walk you through how to open an account, what investments to select in. So if you want that, please go ahead and subscribe to Sisters for Fi, and then I will see you in the next video.